Hey guys, please take the time to review as well as understand this disclaimer I'm going to give you. My name is Dontez Lindsay. I am the General Manager of Ducks Trading LLC, as well as the lead trainer of StockCraft. I'm not a financial advisor, nor a CPA, and the content I create is for entertainment and educational purposes only. I trade in my account, and everything I do is hypothetical in nature because it doesn't happen in your account. My experience with trading is not typical, nor does it guarantee that similar results will be obtained by you. I am merely sharing my opinion with no guarantee of gains or losses in investments. Remember, day trading can be extremely risky. You should be prepared to lose all the funds that you use for day trading. In particular, you should not fund day trading activities with retirement savings, student loans, second mortgages, emergency funds, funds set aside for purposes such as education or home ownership, or funds required to meet your living expenses. Further, certain evidence indicates that investments less than $50,000 will significantly impair the ability of a day trader to make a profit. Of course, an investment of $50,000 or more will no way guarantee a success. Please take the time to review as well as understand this disclaimer for your safety as well as mine. With that out of the way, let's get into the content. We're going to go over important terms in trading that I believe that you should know. Just a little bit more of a breakdown of what's going to happen. I'm going to give you some terms. I'm going to define them in a very broad way. I'm going to give you a few scenarios of how they can give you opportunities to make money in few situations, and then a few variations of when these opportunities do not apply. Now, what that means is we're going to go over about four, maybe three terms, and I'm going to just give you a very brief understanding of how you'll benefit from defining each one of these terms instead of fumbling when it's time to change the plan or abandon ship. Now, with that out of the way, let's get into the video. All right, so as you can see, we have a lot of terms up here. These are about, I can't count, but I'm gonna say there's about 40 terms here, and these are 40 terms that I randomly selected from my important terms in my documents where I like to define things that I believe that will help me get better at trading, or at least organize my thoughts. Now, we'll just start with the first four on these important terms. If you have comments and questions, like leave them below in the comments. I'll get to it. If you see a term up here that you think it should be on this chart, I'm probably aware of that already. I just didn't put it on this chart because a lot of these are categories, and one of the terms you're probably thinking about is either a subcategory or something I didn't think that would be important to highlight right away. Main thing I'm trying to get across right now is a concept. So first one, parabolic. Parabolic is a relative term for technical analysis. It's comparing the chart to itself. And so when it comes to parabolic, it's a big word. It's a big spike. It's a big range created. In my case, I like to consider it intraday, you move 200%. Now on the daily chart, I want to say you also move 200%, but you move 200% from the neutralized area with little to no pullbacks. And now what that means is you're creating a parabolic action, which is something similar to this. So when you look at this chart, it went from around $2, it went all the way up to $8. That's clearly over 200%. And when it comes to a pullback, you'll see that there was this point where it went up to 7, then it came all the way back down to 4. It's a really big pullback. Now, what's the difference between this and like a crack, a gap, and all that other stuff? Well, this chart has different fundamentals and different technical analysis compared to the chart down here, where this went from $6 up to $14, where again, you have another chart that doubled, but you'll see that there's little to no pullbacks on this. Most of the charts from the bottom to the top are green. There's no pullbacks. Now, the difference between these two is this one cracked its momentum and then it recovered that momentum and then continued to make newer highs. But in this case, this doubled with no pullbacks. Like you have this little green candle right here, but it was nothing to the point where the extension broke the momentum. The momentum was consistent throughout the whole way. I consider that parabolic. Now, what's the important part of having something be parabolic or not parabolic? If it's a chart with range, you trade it. If you want to short it, short it. Chances are you might, get squeezed though, if you don't recognize what is parabolic versus like a morning spike or a supernova and things like that. If you want to just go long on it, as soon as you recognize it's a parabolic, you can do that too. But when is the momentum going to shift? You don't really know because it's going parabolic. You're going to have to relate that to liquidity, momentum, all the idea of why did this spike in the first place? What's the catalyst? Did this go viral on TikTok or Reddit like GME and other meme stocks and hype stocks, or things that are trending on a sector? You don't really know. The thing is, the reason I'm talking about this like in a very wide kind of way is because it's all interpretive. Whatever way you define parabolic is right. In my case, I like to define it by the place where it started on the daily, which is the neutralized area, which is something else you have to define. I like to say there's little to no pullbacks. And what does that really mean to me? Well, if you think of things in terms of like price action, range, profit margin, and things like that, I would say having little to no pullback demands that there's going to be a pullback pretty soon. And so when you have something that's over a specific percentage with little to no pullback, stocks don't act like that, especially in the short term. So there's bound to be a correction. And that correction is what I'm banking on. And so when it comes to parabolic, I want to make a definition that makes it tailored toward my intentions, which is short-term, short gains. And so that's why I said I want it to be above 200%. I want it to be from the neutralized area on the daily and have little to no pullbacks. Any of those criteria that are gone is not a parabolic to me. It's just a chart that's running and a potential first red day or whatever else I define in terms of the attributes and characteristics that it fits. Now, that was just one term. Aren't you glad we started? All right, so let's get into the next term, morning spike. So, you could probably break this down for me. Morning. Define what the morning is. I know that might sound like a little weird, but we're all in different time zones. The market might be going at like Eastern time for me. It might be something different for you. The same thing can be said for the word spike. What's a spike? Is that 20%, 15%, 50, 100? No one really knows. In my case, I want to say it's above 50%. Now, why do I say that? Now, again, my intention is to make short-term shorts. Like that's the overall goal for me right now. The rest of that is going to be short-term longs. Main thing is I'm looking for short-term. And when I think short-term, I think high demand, fixed supply, and profit margin. I'm waiting for momentum shifts, and I'm waiting for high amounts of liquidity and spotting points where that liquidity shifts. And then potential catalysts that could either give me an advantage or put me at a disadvantage. In all those cases, the way I define morning spike puts me in that same mindset where I'm looking at this relative term in a technical analysis way, where if I'm looking at above 50%, that means I have to get below, I have to get past below 50%. And now, why is that important? Well, if you know anything about pre-market breakout, which is one of the patterns in Stephen Dux's Freedom Challenge, there's a certain percentage between like 20 and 50%. That's where tickers in the early morning, I'm talking before the open, in the pre-market, they reach the top gainers. At that point, when you're in the top gainers, if you have a popular sector, you're on earnings, or some other catalyst that's going to make investors and traders flock to your stock, you're going to think, okay, this might not be something now, but it could turn into something later. And then that's going to lead to a pre-market breakout. And the main thing is, not only is that depending on the time, which is why I call it a morning spike, but it's also depending on the range created at that time. If there's too much range, people might think I'm already too late. Now, what range is that? That's like a psychological thing. And so at the end of the day, it's interpretive. It can't be too far where it's like 70% or 100%, where, you know, the main reason you want to get into this in the first place is because you want the bulls to come in. The bulls, they're hiding behind the gate. It's not even open yet. The market's not open, and they're hiding behind the gate, and you're sitting there with your short, and you're ready to short like the biggest thing that's going to change its momentum, like whether it be a gap up short or something that's already up really high. But when you get down there in the 20 to 50%, you're taking a leap of faith. You're looking for that breakout. You're looking for that thing that can go to like new highs, and all it needs is a reason. And like, that's where catalysts come in. Now, the reason I say above 50% is because below that 50%, you could have some pullbacks, and that pullback is going to give more room for more people to come in. And then the more pullbacks it has, the more you can see there's going to be momentum. There's going to be repetition in terms of the price action behavior. And during that repetition of behavior, I can start counting those pullbacks. And as soon as it gets above that 50%, most people are starting to change their mind. Like, if this didn't have anything like good in the beginning as a catalyst to make it run in the first place, other than this percentage, then I might be counting like 3, 5, maybe like 7 pullbacks, and then shorten this around like the 80%, because the fundamentals are trash. It's not going to hold its gains at all. And then each one of these pullbacks is probably trapping more bulls. I'm stepping on the early shorts, and that's why I have it above 50%. Because if I made it below that, if I made it something like 20%, that's too low. There's no profit margin. But if I make it above 50%, at least I can get minimum like 20%. And then the reason I say above 50%, not 50% or 30%, is because the profit margin. Now, again, I'm trying to do short-term shorts. And so when you're above 50%, I'm thinking short squeezes. Okay. How much is a short squeeze? That's another thing you have to define. Like, you have to find that statistically, or you have to start figuring out where are early shorts. Where would you short? And things like that. Now, we're only on term 2, and I only explained 2 points. And like, I just gave you several scenarios, pattern, potential advantages and disadvantages and stuff like that. And we're only in the second term. So video is already getting long. I'm going to give you 3 more terms, but I'm going to talk a little bit less. So let's go. We got fresh chart. So fresh chart, you know, long story short, fresh chart. This is when you refresh all reports of resistances and supports, whether that be psychological or technical analysis, or pretty much everything. So the scenarios where this accounts, or the scenarios where you enter the fresh chart territory. In my case, I like to say you've traded record volume, like the most volume ever has been traded on this ticker. And then all supports and resistances, they're bound to get broken, whether it's a resistance and you have all this volume coming in, and the resistance volume, the resistance price has nothing compared to the amount of demand that's created today. For whatever reason, all the previous resistances and supports, they just don't matter anymore, because they won't be able to hold back this new volume, because history can't give you a good gauge of what's about to happen now, because it's fundamentally different now. Other than that, speaking on the fundamentally different, that's where you can have a split. Now, whether that be a reverse split or a forward split, that's going to increase supply, mess with the demand, it's going to pretty much change the fundamentals of the stock. And at that point, not only are you going to have to handle the demand, you're also going to handle the supply, which are in two separate categories, which indirectly affect each other. If you have something that attacks the supply, people might see that as a discount and they'll increase the demand. You have a reverse split, like penny stocks trying to survive. It hits that $1, that $1 threshold before it's being delisted from NASDAQ. And, you know, they do a reverse split and then turn it to $10. And people are just like, you didn't see that, did you? Like, nah, we weren't going bankrupt. We were just kidding. That's what the reverse split was. Now, with that, that's a refresh chart too, because the fundamentals changed, the resistances and supports, they all just like disappeared because the whole price just changed because of the split. In that case, you can have a fresh chart, but I'll give you one of the scenarios where you don't have a fresh chart. I say that ticker had warrants. Now, you also have to define what is a warrant, what is a warrant used for and stuff. Well, I'll give you the abridged version. Warrants is pretty much when a company wants to pay itself. It has to pay bills, and it's like, hey, I'm going to hire a pumper real quick, make my ticker gap up, you know, like a gap up short. And then I'm going to sell my insider shares, and I'm going to take some profits. I'm going to go pay my bills. That's what a warrant's for. Now, the price at which they release that warrant, that becomes a resistance because people are going to realize that warrants were created at this level. And when that happens, people get trapped at that level because, you know, they might not see the news that warrants were created like at a certain level. And then that creates a resistance there. Now, that doesn't matter if there's a split there or not, because at the end of the day, you have to understand what is resistance. Resistance is bag holders. Resistance is like psychological fear and mostly just bag holders. Because there's a certain amount of price action that just trap people at a certain price level. And remember what a fresh chart is. No supports, no resistances, because they all got refreshed because something fundamentally changed. Now, with the warrant, it's pretty hard to dodge that. It's pretty hard to fix that because everyone knows that the company did it. Now, that's all I'm going to really say with that. Last 2 points. Let's say on a ticker you had little spike history. Like, it's pretty much a flat chart. It's also a downtrending chart. And so not only is it not spiking, it's slowly just heading down. And with that, it's also on low volume. And so it's just a slowly dying company, or people that were originally like pumping this stock, they're slowly getting out because they're realizing that this is a dying company and something like that. At that point, you know, there's no resistance because it's a slow grind. With a slow grind, all bag holders are getting out because it's moving slow enough just to break everyone to the reality that, you know, I don't want to buy this. Also don't want to hold this for a short because it's so slow. It's like, who would do that? Unless you have the money to do that in bulk and then make money off that large percentage. But that's a minority of people. The last one is a flat chart. That's pretty much similar to the last one. You have low volume, you have no price action. It's just a flat chart. And remember what a fresh chart is in the first place? You have no resistances and no supports. All the historics just became fresh. And so why is that important in the first place? This is one of the criteria that you will need for a gap up short. Because in fresh charts, that's when you'll see long investors, like actual investors, not traders, but actual investors try to take money when there's a gap, like some type of catalyst that comes in and, you know, this stock that's been flat for, you know, fill in the blank amount of time, let's say 6 months, it goes up to 100%. All those long-term investors, they've been waiting for some reason to get out. They take their money because they put in a lot of money. As soon as that momentum shifts because of that consistent resistance or that fresh chart, that's where you short, because the momentum shift is like the catalyst that brought this up was probably a pump anyway. Yeah. Now, we already touched on warrants a little bit, which has its own kind of like history to it. But I'll give you the bridge version of that too. Like I said it before, the company wants to pay its bills. They already pumped the stock and they sold their insider shares at a specific price. Now, what kind of effect does this have on the stock? They attacked the supply. They expanded the supply so much to the point that it cut the demand. And usually when you have like a gap up short that had a warrant happen like right at the top or like in the aftermarket or pre-market and stuff like that, you catch so many people off guard that you'll see a stock drop all the way to like 80 to 90% in a day or a couple days, or most of the time it's a couple days, because a lot of people are thinking that it's going to come back. But with a warrant, it's one of the ones that attack the supply to the point where a lot of people get trapped. And instead of normally having a pullback of like 30% to like 50%, with a warrant, you start seeing these gains of like 80 to 90%, and a lot of people get trapped. Now, those are all the terms I'm just going to give you today. Of course, I can keep going, but I'm already at the point where I feel like I talked so much just for four terms, and I could definitely go over the rest of these, but I want to hear what you guys think. All right, guys, that's it for today. We talked about parabolic, morning spike, fresh chart, and warrants. Now, the first two were relative terms that are technical analysis, where you're comparing the chart to itself. Second one was a fresh chart, which is a detail or a characteristic. The warrant, that's more of a catalyst or news that you're going to use for another factor in terms of winning percentage, add it to your patterns. But that's stuff you're going to have to learn about later. Main thing is, I tried to highlight why it's important to define an important term and a few of the situations and variations you can run into. And if you like this kind of video, leave a comment below on what you think, and like and subscribe, and I'll see you guys in the next video. Peace.